Hello everyone, welcome back to my channel where I track my net worth and speak about various investments. In today's video, I'm going to be speaking to you about why I sold the ETF SPHD, or the Invesco S&P 500 High Dividend Low Volatility ETF, and why I decided to purchase the JP Morgan Equity Premium Income ETF, also known as JEPI. And if you do enjoy content like this, please consider liking the video and subscribing to the channel. It would be greatly appreciated. So I use JEPI as kind of a foundational holding for my portfolio. Overall, it's a relatively minor percentage of my total holdings, about 12% or so. We got $9,800 here currently. And in early September, I sold SPHD, which was my foundational holding, and I bought JEPI instead. Here is the buy and sell order for that trade. Now, both of these ETFs do pay monthly. As you could see here, this is the NASDAQ fund page for the fund for JEPI, and it pays around the first or so of every single month without fail so far, and it is very consistent. And you do also see the fund page for SPHD on the NASDAQ page, and this was also paying every single month. And it was toward the end, but it is relatively inconsistent. So it pays sometime between around the 15th or so to any time to the end of the month. Although generally speaking, it does pay consistently approximately the last week of every month. And now with JEPI, this is an example of one of those dividend payments we see here. On November 6th, I was just paid, which was the most recent payment, and I made about $65 in the beginning of the month, just from that holding itself. So why did I sell one for the other? And I think that it is pretty simple when you look at the finer details of both of these ETFs. So how SPHD works, that it basically takes the top 50 dividend yielding companies and screens them for low volatility, and that is pretty much the metric there. The selection criteria is very basic, and at the end of it, it pretty much looks like it's chasing yield instead of capital appreciation whatsoever. So if we take a look at these holdings that this fund has, you see that many of these holdings are companies that have been beaten down recently and that don't generally perform well overall. So if we take a look at just the top three holdings of this ETF, we have Verizon, AT&T, and Altria Group. And not a single one has been performing well year to date. We have Verizon down about 8.5%. We have AT&T down 14%. And we have Altria down about 10.3%. So while these companies do yield high dividends, a lot of these companies have been down recently and overall don't appreciate through capital. They just pay out their dividends, and that's that. Don't really think about capital appreciation for any of these stocks. And that holds true for just about every single one. Even if we go down the list, we see that none of them really perform well overall, and they don't really have a history of performing well overall. They are well-established companies, but again, they are pretty much at market capacity, and they're not really going to grow. They're just going to pay whatever they get out through dividends mostly. And if we contrast that with JEPI, the top three holdings here, it's first off, it's a little bit more well diversified than SPHD is overall. While that only holds 50, this holds quite a few more, with 133 being the total number of holdings. And if we look at the highlighted top three, we have Amazon, Microsoft, and Adobe. So Amazon has been up about 70% year to date. Microsoft about 58%. And Adobe, we have about 82%. So I think the contrast is clear. First, this fund is more diversified, and overall it has better holdings. Even as we go down the list, it is a little bit more suited for growth than it is dividends. So I ran these two holdings through Portfolio Visualizer. What I did is I did something very simple, just did an initial investment balance of $10,000 and reinvested dividends And this is only for 2023. So there is a little bit of historical history that's lacking here. This is just again for 2023. So these are how these funds performed against each other. And you can see that JEPI blew this fund kind of out of the water. It performed $1,200 better, and SPHD actually lost money, about 9.9%, while JEPI had a total return of about 3%. The standard deviation was a lot less, so you would expect less volatility with JEPI than SPHD, which is interesting because if you remember the holding description, it screened for volatility. So this fund is less volatile than the fund that kind of screened for volatility with its holding. We have a lower max drawdown as well. And now JEPI operates on a different investment scheme. It goes and it generates income through a combination of selling options and investing in U.S. large cap stocks, seeking to deliver a monthly income stream for associated option premiums and stock dividends. So unlike SPHD, the investment methodology of this ETF is that it invests in large cap stocks, like the ones I mentioned before, Amazon, Microsoft, Adobe, and then it sells basically covered calls through something called equity-linked notes against the S&P 500. So you get your income through a variety of dividends and through covered calls through equity-linked notes on the S&P 500. And if we look at these head-to-head through dividend yield, we see that SPHD has a current yield of 5.33%, and JEPI has a current yield of 7.94%. So we see that JEPI as a dividend ETF has a higher yield, which is good because that is part of the reason why I transferred over between SPHD to JEPI. So it pays me more. It also has better holdings. And as we saw with the portfolio visualizer, it pays better over time and appreciates more. The one downside to JEPI right now is that it has an expense ratio of 0.35%, whereas SPHD has an expense ratio of about 0.3%. So you're paying more for JEPI slightly than SPHD. Now, however, given the returns over time and the outperformance of dividends and dividend yield and so on and so forth, I think that around 0.05 of a basis point there is definitely worth the trade-off. So that is not a major impact to me. I'm comfortable with paying a slightly more expense ratio for that clear outperformance of JEPI. And now kind of bring the viewers into the mix, because I definitely do appreciate the comments you guys give, even if you are against my investment methodology. This viewer wrote a comment, big no thanks on JEPI, and there are 2 likes associated with that. So there's definitely some disagreement with having this for a holding, and I can understand why people are against this as an investment. If we look at the performance of JEPI year to date, we see that it is actually down. Now this isn't with dividends reinvested, I believe. I believe this is just a chart of the equity overall. So basically the price fluctuations, no dividends reinvested. We see it is down over the year. Now, if we contrast that with the S&P 500 overall, this is just the VOO ETF that tracks the S&P 500. We see it's up substantially, quite a bit, 19.3%. So if you're investing for growth and not dividends, or you just want strictly performance, I definitely would agree that something like VOO or the S&P 500, whether that's SPY or another fund, would of course perform better. But the reason I'm holding it is for dividends. So if we compare that to the ETF that I just sold, SPHD, we see significantly down over the past year to date, about 10%. See another extremely common dividend ETF. I actually hold this one too in the same portfolio. This is SCHD. the Schwab US Dividend Equity ETF. It is not down as much as SPHD, but it is still down about 5% more than JEPI. So JEPI has performed better than even this ETF. Another very common ETF is the Vanguard High Dividend Yield ETF, or VYM. It is also down, not as much as not as much as SCHD, and not as much as SPHD, but it is still down more than JEPI. Now, full disclosure, there are ETFs that have a methodology to produce dividends, and one of these ETFs is QYLG. It pretty much sells covered calls on the S&P 500. So it'll basically own, for example, 200 shares of the S&P 500, or like an ETF like SPY, and then sell covered calls on just 100 of those shares. So it does a 50-50 split. And the idea of that is to generate income while allowing for growth. And we do see that it is performing extremely well year to date overall, and far outperforming JEPI. And we also have QYLD, another extremely popular ETF. It pretty much sells covered calls on QQQ, or the NASDAQ, and it is also outperforming JEPI as well by a decent margin, and it also pays a fairly high dividend. So both of these ETFs have outperformed JEPI year to date. But if we expand outwards, we see that over time, this ETF kind of just depreciates, and we don't have the historical performance of JEPI to kind of figure out how this will perform over a long time. And we don't have that much historical performance for QYLG either, but it is lagging as well. And it performs somewhat in line with JEPI to begin with. It holds up pretty much just as well, and JEPI seems to pay better dividends over time than QYLG, and their investment metrics are a bit different. JP Morgan, the JP Morgan Equity Premium Income ETF, of course, has different holdings, and it is not exactly in line with the S&P 500. So if you want a bit of different diversity for an ETF that pays dividends through covered calls, then I think JEPI is a better mix than just QYLG, because it is less linked to the performance of the S&P 500. So in summary, I bought JEPI over SPHD because it yields a higher dividend. It has better performance so far. It is more diversified, and the investment methodology, I believe, is far superior to SPHD. So if you currently own SPHD, I know that it wasn't too much of a popular ETF to begin with. It was somewhat of a popular dividend ETF that paid monthly, just like several others within the monthly paying variety. You might want to consider JEPI, or at least take a closer look. Hopefully this video gave you some good information on it. That's going to be it for today's video. I appreciate you all for watching. Again, if you did enjoy this content, or you want to see more like it, please consider liking and subscribing. It will be greatly appreciated. Thank you, everybody, and have a great day.